Alrighty. Welcome everybody. This is Armor Bull Trading. So give you a quick look at the Discord if you're watching this on YouTube in the future. So we have basically the full breakdown here. And this is only if you're an upgraded member, you can see all of these things. Alright. So we got all my YouTube stuff, books and everything like that. And then where all the action happens is the Ascendant Traders. Nugget Pocket is pretty much everything in here is available for the lower end upgrades. All right, same thing for the rest of these executive relations. I got associations with a lot of these other groups with high quality individuals trading as well. So we're going to go ahead and move forward. All right. This presentation is going to be on, first of all, welcome to Armor Bull Trading. This presentation is going to be on $5,000 portfolio stock list. So do you have to only have $5,000? No. Can you have more? Yes. Can you have less? Of course. Whatever it is that you're starting with, that's going to be, what's going to be good for you, right? So stocks that have growth potential and some that pay dividends is what we're going to be going through here. And I'm not going to break down each and every one of these stocks individually. But I will just go through basically the list of names. I'll share the charts. I have some chart examples built into the presentation, but since I'm doing this live recording, I may have some people join in the video, so be prepared for that, and they may be asking questions, etc. So feel free to listen in on that, and as well as going over those stocks and stuff like that. It'll be very simply broken down. It's not going to be difficult, but I'll show TOS too and pop up some of the stock charts and things like that so you can get a better look, going through this video versus just the screenshots from the presentation. All right, moving forward. Of course, we have the beautiful disclaimer, and I do have to read this out loud. Don't think because this is available to you being taught by me that this is financial advice, trading advice, direct or indirect direction to trade or not to trade any particular stocks, ETFs, or any other financial assets or classes. The video is created 100% for educational and entertainment purposes, providing you with information on certain assets that you can find on your own. I have done the guesswork and found them already. There are so many more options and good mentions, but these are my picks. By continuing this video and presentation, you accept this disclaimer. Stop the video or discontinue watching if you do not agree to these terms. All right, go ahead and proceed. Note, stocks and ETFs provided are stocks I often trade myself, and I have history in trading them. All right, this is not just some random list that I put together just because they pay dividends, etc. I have pretty much traded everything in this list except for things that are IPO'd, not released yet, and or other stocks that I just haven't held long. All right, I'll give you a minute to go ahead and look at this. This is the first set here. Assuming you start with 5,000, this is the breakdown. So what I did was I took the $5,000 balance and I divided it by the amount of stocks and ETFs we actually have shown here. So of course it's very simple. So 1, 2, 3, 4, 5, 6, 7, 8. Okay, you take $5,000, you divide it by 8. That gives you $625 that you will distribute to each one of these stocks and or ETFs. What you can do in that event is, obviously the dividends are the more attractive ones, right? But you don't want to steer clear of growth stocks, because if you look at the breakdown of this, you can actually get a really good portfolio broken down as far as I'm not going to say diversified too much, because I feel like SPYD, XLF, they sort of can go together a little bit, and possibly even NLY. So when the market crashed, or flash crash rather, back in March 2020 for COVID, a lot of these had big hits, but some of them barely got touched at all. InfoBird is new, IPO this year, 2021, so that was not affected, but MJ, NLY, SPYD, XLF, THNQ, they were all affected. NEO was affected as well, not terribly, and it was actually in the growth stage back then, so you see a lot of growth coming from NEO. I think NEO has a good future ahead of it. I feel like it can easily get into, these are purely projected numbers based on history of price targets and things like that, and based on actually competing with Tesla and other EVs and stuff like that. So I feel like just in my opinion, price projections. Let's go from the top to bottom. MJ, I think she could squeeze back to $40 to $90, maybe $100 a share for that ETF, paying 36-cent dividend every quarter. And all these dividends are actually quarterly on this page here. The other ones I have broken down, they are some of them are monthly and some of them are quarterly, which I have broken down. Glad, I believe, 12 to probably $25 to $35 potentially in the future. It's Gladstone, NOI, Annaly Capital. This stock really enjoys staying between. It's a real estate investment trust. It really enjoys staying between $6 and $12. The sweet spot is really 7 to 10. But the dividend is really great, so you can actually get some good money coming back around for that stock, and it held value. It only went down to like 6, I think, during COVID. From 10. So yes, it technically lost a good chunk of itself, but at the same time, it's been back over 10 already, and the dividend is still staying strong between 18 and 25 cents per share. So now SPYD, I feel like this is just going to continually grow. I mean, easily 20 years from now, that'll probably be $100 to $300 per share unit, and the dividend per quarter is $2.24 per share, which is awesome. So if you felt like, okay, I don't want to put too much risk on NOI, you could totally shift some of that value into SPYD and or XLF or THNQ or something like that. XLF price target is generally compatible with the financial institutions, so like Bank of America and things like that are packed into this XLF ETF. If you look into the dividend as well, 72 cents is pretty hefty, and the share price is very fair for that dividend. And I feel like XLF can easily push on upwards to 80 to 115, in 10 to 20 years. And again, this is long-term investing. And if you didn't know already, Roth IRAs is probably, the best way to invest your money overall, because it's taxed up front. So when it comes time to use that money, you're not going to get taxed twice on it. Check with your tax advisor or whoever you use for taxes to verify dividend income and things like that. Maybe they're taxed differently, so just make sure you cover your bases there. THNQ is artificial intelligence ETF that's very, very strong. I mean, this thing has had pretty much no backlash, and it just keeps pushing up harder and harder. So you could definitely go ahead and push further away from say Glad. Say, okay, I don't want to put 52 shares at $12. I want to do a few more shares of THNQ. And same thing with Neo. Now, InfoBird is a very special stock to me. It IPO'd. I watched it. To me, it's comparable with Salesforce CRM. If you go look at CRM, you'll notice the prices in the $220 to $250 range, depending on when you're looking at this video. All these share prices were updated today, July 26, 2021, and I updated the share count with the $625, divided out. So it's all accurate from what you see, give or take 50 cents or something per share price. Maybe I rounded it up to 37 from 36.50 or whatever. InfoBird, even if it only goes at its all-time high of 11.25 per share on IPO opening day, even if it only gets back to that, you're at that point pretty much quadrupling your return. And that's lowballing hugely. It took Salesforce a long time to get to where it actually is now, and it's like $10, I think, for years, and then around 10 years it hit this huge uptrend. Now granted, this could have been from COVID and things like that, because it took a lot of its growth in the last 2 years. So we're in mid 2021 now, so basically 2019 to 2020 was probably a lot of growth phase for it. So I feel like InfoBird can really do the same. Now if it breaks down below like $1.50 over the next year or something like that, I'll have really close attention on it, because of course at that point you are losing a decent amount of your investment in that specific stock. Now again, this is why you're diversifying into these different areas here. because MJ is for marijuana. Once it gets legalized, we all know that there's huge growth potential. And I think THCX is another ETF from cannabis, but I don't think it pays a dividend right now. Um, so, if you're invested in one of those, you know that they're going to be sharing a lot of growth with other stocks. MJ tagged 30 something dollars again earlier this year, I think in February roughly. So you can look at the price charts and just see, that there's a lot of potential there. And if you're collecting dividends the whole time, the only time I'd recommend selling any of these, for actually taking your gain would be if it just went stupid high price wise, right? And then I would reinvest that into something different that paid, that I can increase the quantity, have a quality stock or ETF, and still get another dividend. Or likewise, say, for example, let's say Neo shot to say 150, $200 a share, right? And we bought it say 39. Okay, you're making a huge return there, right? But how high can Neo really go, right? It could, and of course, go to where Tesla's at, around $500 to $700 range. But if it does not do that, and you miss that huge capital gain, it's always, are you scared to lose your money, or are you okay holding if it goes back down, right? So, for example, anybody who's in my chat or been following me on Instagram or anything like that knows that I'm in AMC pretty heavy, right? I'm still up $30,000 on the shares, and I'm still up technically $3,000 on the options that I had and flipped a few times. Now, granted, I was up. You'll see my Robinhood account later in this video. It was I was at about 10 grand just like 2 months ago, 3 months ago. Let me see if I got anybody waiting real quick. Okay, we're good. And that was for the options that I had open on it. And of course, we all thought it was going to squeeze back then, which was just a couple months ago, but it did not yet. So I'm just still steadily adding shares, and I'm still holding long at this point, January 2023 options, 85 or $80 strike, I believe it is. And you'll see it on my portfolio shortly here. But I also have a huge hedge position because I always protect my trades in some form or fashion. And if you join my group, you can learn how we do that. And I teach everybody those things. And my books have it as well. They're on Amazon. Real Options That Win, and also Mastering Debit Spreads and why I don't trade credit spreads. So let's move forward here. So Infobird, last but not least there, my point is at 280, this is the lowest I've seen it so far. It trickled down, but it's been bouncing around a few times. It was $6 not long ago. So at this point, it's a hit or miss, but I mean, you can get 223 shares, multiply that by, $11 a share, and you've got a fat chunk compared to what you're paying for this, right? So let's move forward. On the right, you have IPOs hitting 2021 to 2023. Coursera, called that one. That was beautiful. Opened around 30, went up to like 50 something or $60 a share, I believe it was. And I definitely traded that. Made a good, I think I sold at $10 a share gain. So I made a little bit of money there. UiPath, I have not traded that one yet, but it is live on the market now. Robinhood has not IPO'd yet. Databricks has not IPO'd yet. ThoughtSpot, which I think has got huge potential, has not IPO'd yet. And Instacart as well has not IPO'd yet. Okay, let's move forward. So again, this is a carefully put together lot of a portfolio for a $5,000 roughly long-term account. The reason I did 5 is it's an easy base number for most people to come up with in a year or so of saving, if you're saving appropriately. If you have a 401k that you control yourself, or IRA that you control yourself, or even if you're just putting away money, on your own, and you get, say, $5,000 in a savings account. Well, a savings account is not going to pay you anything besides garbage, right? You're going to get basically no return in a savings account whatsoever. The purpose of a savings account is literally to save your butt on a rainy day, right? So say, your engine blows on your car and you don't have any warranty, you got to come out of pocket 2 Gs to get a motor replaced or something like that, or maybe more depending on what you drive, or maybe less, whatever. And you have that cash to back you up, because you don't want to be putting stuff like that on credit cards, because it's going to destroy you in the future if you can't hurry up and pay that back, because then you'll be rotating, okay, so you still got a car payment on that car. Well, now you're paying a car payment and you're paying for the motor you just had replaced, right? So there's all these different variables that get factored in. So you have to be smart with your money, okay? And just like any portfolio in long-term investing, the idea is to constantly add to the portfolio, to make the compound effect more direct and stronger. If you can add between $3,000 to $7,000 per year, which is roughly 250 to 560 per month. Now, for most people, that may be difficult, but for a lot of other people, it's a very simple target to hit. It just depends on how much money you're willing to save for your future. Okay, so yes, there's a lot of people that believe that use your money now, blah 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 blah. Live it up while you got it, etc. Which I can agree to a certain extent, but then again, that's assuming you know the future. If you think you might die in 2 years, of course, yeah, spend all your money now and have a good time. But if you live to 85 and you have 10 grand saved, for your retirement, and you're living on Social Security, if it even exists by then, what are you going to do? Okay. Let's keep this. I'm trying not to be monotone here, but I'm gonna be quiet because the kids are sleeping. So bear with me here. Let's have a little espresso. Number one is gone. Number two. Pardon my slurping. I feel like 250 to 560 a month is actually a pretty easy target, because if you make, $5,000 a month, that's only roughly 10% of your income that you're saving. Same thing if you only make $2,500 a month. The same thing. There's only 10% of your income. So I feel like those are very easy targets to do, considering that if you just look at a pack of cigarettes a day or a cup of coffee a day from Starbucks is roughly $4 to $5 now. That's about $2,000 a year that you're spending on coffee or cigarettes. Or assuming it's something else that you're a creature of habit, you buy snacks out of the vending machine every day, or something like that. You can easily displace something and save that money, right? And putting it in an account like this, it'll help it grow. And then assume you're like, it says it later here, and I'll just finish reading this here. So basically, you're buying the dips, you're riding strong, you're buying the dips again, right? Assuming you're maintaining your due diligence on the stocks and ETFs in your account. That's your job, right? It's nobody else's responsibility but yours. It's your money. Your money, your choices is your responsibility. You can look at this whole video and then decide you want to do everything that I mentioned, or none of it, or some of it. It's all up to you, right? And I believe that this group of, obviously so many more, but these are the ones I have faith in as far as my picks go. There are ones that are even in my list that I have faith in now are questionable in the next 10 years. Like Gladstone, I don't know how strong they'll be. I don't know how strong NLY will be, but as far as the other ones go, InfoBird, MJ, THNQ, SPYD, I feel like those are very, very strong in my opinion. And even watching them through COVID, it's basically barely touched them. It barely harmed them at all. They maintained the dividends, and they maintained a hefty growth overall in the last year or so. So unless we have a market crash, right, that's unpredictable, you have to prepare to buy the dips essentially in this situation. So if you have something that you'll buy at $25, $30, let's go with the Warren Buffett factor here. If you're willing to pay 30 or 40 or $50 for a stock or an ETF that pays you a dividend, and it drops down to $10 or $15, why in the blue world would you sell it? If you already paid that much, first of all, you just lost half or 70% of your investment if you sold it, when you could just buy the dip, average your total price down, increase your dividend payout, or increase your future return based on the growth. I mean, it makes perfect sense, okay? In my head, anyway. I mean, if you disagree, please feel free to like or comment below and let me know. And if you have any disagreements with me, that's fine. It's a free world. The market, buying, selling, if your opinions on these stocks and ETFs is different than what I'm saying here, then that's completely your opinion. And I appreciate, a nice debate. So, as long as you don't get crazy with it. But anyway, I believe that you'll yield a nice retirement overall, or just, fun money in the future, right? Especially if you're only in your 20s up to 30 years old, roughly. The older you are, the more you'll have to add to try to keep up with the return rate for a younger person. So sucks for us 30-plus-year-olds that, have to put more to get the same thing. So the point is solid. Yes, you can add other great, valuable long-term stocks if to this if you know that they're worth it, and either dividends, price improvement, or both. So if you know something like, to me, SPYD is one of the perfect ones. 5% return as far as your dividends go, per share. And it's like, okay, say I buy $40,000 worth of that, and I get a 5% return every quarter, assuming the price stays flat per se. And it's actually really strong. It actually stays in like a $5 swing range, so it's really good. It basically follows the SP 500 mini SPY. So SP 500, then you have SPY, and then you have SPYD, and they all pretty much follow each other, right, as far as numbers go. So if you look at SP 500 and look at SPY is sitting over here at 439, 438, something like that, and you're looking at SPYD is roughly $40 a share, so it's right there around the same thing. Okay, so that's what you got to look at, and your dividend return is huge. And as far as back to that 20 to 30-year-old thing, I actually did a calculation with someone making, was it 18 years old, making $30,000 a year and investing, starting with zero, but then saving, I think it was $5,000 a year, moving forward up until they were 60. So that's, let's just call it easy and do 42 years. Versus a 30-year-old making $100,000 a year, starting with, I think it was $10,000, and then adding another, I think it was $5,000 or $10,000 per year. And the 30-plus-year-old making that much more money, saving that, still because of such a low year return, 30 years at that point. So that 12 extra years gave a massive difference. I believe the younger person had 1.6 or 7 million in the end, and the 30-plus-year-old only had about 800,000. So that's a fat difference. That's literally almost double. So the point is very solid. I mean, it's saving now while you're younger, especially you young cats that are, 15, 18, 19, 20, 25. You still, if you're getting on this train now, you're just doing yourself such a huge favor in the future. Okay. Let's go ahead and move forward. These are other examples of other long-term dividend and non-dividend stocks. The dividend obviously are listed at the top, and I actually have it broken down very easily for you to look at this, screenshot it, look up yourself. All these price quotes were updated for today, July 26th, or 27th, I'm sorry, at this point. So first you have Realty Income, stock ticker O, sorry. 23 cents per month per share. You're looking at $71 a share. So for me, I feel like that's a little hefty. However, it pays you monthly. So you're getting 20 cents per share monthly. So 12 months, I mean, you're getting, you're going to get a little bit there. You're going to get $2 a year per share, depending on how many shares you have. That makes a lot of difference. Then you get a Main Street Capital here, ticker MAIN, Main, 20 cents monthly, but $41 a share. Now, to me, that's a lot better risk reward as far as getting a dividend for the share price, $30 cheaper than the first one. So again, same thing. Now you're increasing your dividends. Stag Industrial, so STAG is ticker, 12 cents per month, $40 per share. Not quite as good as Main Street Capital. But then you have Gladstone Investment Gain. I don't know why I said Gladstone earlier. Anyway, Gain is 7 cents monthly, $15 per share. Now, it's very interesting because if you look at the cost effectiveness of $41 per share at 20 cents a month versus $15 a share at 7 cents a month, the quantity that you can get for doing the $15 a share makes it a lot different, right? So you can add a lot more shares. So you're basically getting 2.5 shares of Gladstone Investment Corp gain versus 1 share of Main Street Capital there. And here's the thing. So 7 times 3 is what? 21. So you can actually get 3 shares, getting you a tad bit higher dividend, still paying monthly of Gladstone Investment Corp gain. And in the event that it continues to increase over time, say 17, 18, 30, $50 a share over the long term, and you're getting paid out that sweet dividend the whole time, that is quite the return that you can receive. Now, the best thing to do, in my opinion, and what I would probably do, would be to add, for every 1 share of Main, I would buy 3 of Gain, and I would go from there because I'm getting the same return for the same amount of held item. But then again, you don't know which one's going to grow more as a stock price. So you always have to keep those things in mind. But how you can figure that out, obviously, is to go over to your chart and check it out. Now, for the ones that are quarterly paying, you got a few coming up quarterly. And what you have to do is basically break it down to show you, okay, the share price, and then you have what's the dividend per quarter. So Altria Group, obviously pretty strong, stock ticker MO, 86 cents quarterly, $47 per share. It's actually not bad at all. It's actually kind of nice, which kind of equals out to similar what those other ones are above monthly. But it's just nice to have, once you get, say you decided to put $10,000 on each one of these, right? That $10,000 is going to return you all that dividend money. And if you have it paying you every single month and every single quarter, like compounding, and then you just leave it there and you just let it grow and grow and grow and grow, assuming they don't stop paying dividends and assuming the share price stays fairly moderate within maybe a 20% range of where it's currently at. When you start buying, continue adding those shares, you continue adding your dividends, et cetera, et cetera. And in 30 years, you can just compound interest is a wonder of the world. It's amazing. And then you have AT&T, of course. T is the ticker symbol, 52 cents quarterly, $28 per share. So that's actually extremely competitive versus the Altria Group there as well. Then you go on to Coca-Cola Company. Well, Coca-Cola has been on an uptrend forever, basically, and it's been around forever. 42 cents quarterly, $57 per share is pretty safe, in my opinion. Walgreens, and then you have CVS as well. Walgreens ticker WBA, 47-cent quarterly, 47 per share. And then you have CVS, of course, Health Corp, 50 cents quarterly, $83 per share. Now, between those two, Walgreens is technically the higher paying of the two and is half the price roughly of what CVS is. So that's up to you. However, if CVS decides to go back to 100 plus a share, you're going to make 20 something dollars per share there. Now, I believe Walgreens was up there a little bit, closer to 60s. So you have to keep those things in mind as well. Honorable mentions on the bottom here. Of course, you guys probably know a lot of these names. Some of them are newer. Some of them are different plays. Some of them, well, you kind of got to go with the flow. So NVIDIA, of course, NVDA, AMD, Advanced Micro Devices, Amazon, AMC in there. Apple, of course, forever long term. GE, of course, is doing much better now. They split their company again. Not the stock, but the company itself is split division. Tesla, of course, TSLA, and bots is, I believe it's the artificial intelligence as well, along with advanced technology and robotics. I enjoy that stock as well. It's a pretty safe price. Datadog, one of the fairly new ones, I believe. Coin, which is Coinbase, that IPO'd earlier this year. I got ripped on that one a little bit. Opening, I bought it around 385, watched it go to 430, and then watched it tank all the way to 320 within a few days. So the market makers were just destroying us on that. XOP, then you got Lucid, LCID, Lucid Motors just came out. I think that's direct competition with NIO and Tesla both, and I think they're going to have really good cars going out forward. And what I would like to see with that is that share price just like go crazy. So they got strikes all the way. They have great options, expiration dates. I'm going to start probably trading that pretty often, and I'll probably start a position in those. I've got a few dollars laying around in my other accounts. Most of it's going to AMC, but I feel like that can be a very nice turnaround there. CGC, Canopy Growth, Oracle, and then INSG is a big 5G player for once. 5G really rolls out completely. And then PaySafe is supposed to be like another PayPal, but we'll see how that goes. So I feel like these are all honorable mentions. Let's go ahead and move on. So why are these stocks good picks, right? How do I decipher if they are safe for the long term or not? Excuse that typing error right there. How do I decipher is? How do I decipher if they are safe for the long term or not, right? So what do? Well, that part's simple. So I simply look at the long-term charts on the max weekly, on TOS, or monthly, or quarterly. If the stock has been on the exchange that long, examples of long-term charts on the next few slides. You want to ensure there's a long trend that steadily increases. It's acceptable to have had very high highs compared to its relative current price. The dividend and the price stability is the most important thing. Again, these are long-term investments, not trades, short-term or and again, unless they like explode, and you get like a 500 or 600, 700% return, it's in my opinion, it's okay to take those profits and then move that money and then wait for a potentially, lower price to come back around. Now, in some cases that doesn't happen, Like Tesla went to $900 a share again after it split, and then it got shorted all the way back down to like 500. So yes, you could have waited at 900 and making money is going to go back to 2000 like it did previous split for last year, but no, it turned around and went right back down all the way to 500 and some change. So those things you have to keep focused on. It's your responsibility to maintain that due diligence on your portfolio. Okay, so here you have CVS. Now let's take a look at this chart. And these are all special indicators that I have designed in my TOS. Some of these are scripts, and I actually sell my script for only like $7.50. So if you use TOS, feel free to message me, and I'll be happy to send you the link. And if you look at the top left here, you can see that CVS, this is 1998 all the way to 2021. You can see we have a very clear uptrend, right? You have that massive 113 move upward, and then of course you have it came all the way back down to the 50 range. Now, if you look at the date, you can kind of eyeball where that's at. I chopped the months off, but let's see, 2021. Yeah, so you're getting back in here for 2021 and 2020. So a lot of this was COVID and stuff like that kind of drew the market down. So keep those things in mind. The CCI is the Commodity Channel Index. This is my favorite secondary indicator that there can be. I change my settings on basically every indicator I use, especially secondaries, because the ones that you're flatlined with on default are generally not quite as good as when you modify them. When you modify them, you can get a lot better view of what's going on. Moving forward. This is Walgreens. Again, you have a very similar chart. If you look at CVS versus Walgreens, forgive the shrinkage there, but they have a very, very similar chart pattern. What are those blue lines on my chart? You may ask yourself on the top upper chart. Those are Bollinger Bands, and no, they are not set regularly. So if you want to know how they are set and how I use them, feel free to DM me or leave comments, and we can connect. Or you can email armorbulltrading@outlook.com or thefishhooktrader@outlook.com. All right, and these prices again are from today. So here's NLY. So again, this is NLY. This is why it's a I won't say sketchy or uncertain, but what I will say is that you have to be careful with it because it does have these very high highs and then very low lows compared to its normal base prices. But you can see that it's been as high as 21 and as low as 3. And matter of fact, I misspoke earlier. I think that 351 actually was during COVID, 2020 March. So if you look at that, but you can see that this dividend is very clear all the way across here, and it's just steady pay. You can't really see the number, but those things you have to keep in mind as well. So if you're starting now, assuming it doesn't drip back down to $6 or something like that, and you're steadily getting that dividend. But $6 actually is a long time support. So even if it did go back to that, that's still an okay range. Hopefully you haven't lost too much money at that point in that event. But otherwise, averaging down or just letting it ride out or just cut it loose. There's nothing wrong with cutting losses, right? But if you're taking a nice dividend and it hasn't changed much, there's nothing wrong with just letting it ride a little longer and have a stop loss set in your mind, because generally when companies pay dividend, the stock price drops a little bit because the dividend is being paid. So in that event, you want to make sure you're not beating yourself, right? Don't set a stop loss so close, especially where dividend date rolls around, the X date hits, and then you get a stop loss because it dripped a little bit because people expected the stock price to decrease a little, and then you went ahead and sold, and then you missed your dividend. So don't throw away good stocks for silly reasons. Okay, here's Tesla. Obviously, this is a massive bear flag, bull flag. I'm sorry, massive pennant or bull flag or whatever you want to call it. Huge range, and this is showing you $900. Again, is what I was just talking about. The CCI looks like it's getting ready to round down and come back up. Now, all this really depends on the broader market, but I feel like right now, Tesla's got two huge supports coming at it from this long-term chart. And again, this is all this year, so we could face a slightly further downtrend, or it could go ahead and squeeze and break out. The moment it breaks back over that $700 blue line you see there, the second blue line from the top on the right, sky blue, chances are we'll get another breakout back to 750s, 800s. But otherwise, we could break below where we're at right now at the 640 mark, and Tesla could drip on back down, but it doesn't appear that way. There's a lot of buying pressure. People love Tesla, but with Elon Musk mentioning the other day that he may or may not be present for the earnings calls in the future, that could have a negative toll on it, but apparently there were no Bitcoin transactions, so that was another reason for the stock to stay, I guess, where it is. So they're probably not going to split again anytime soon. Probably 5 to 10 years if that happens, and maybe more. But otherwise, I think Tesla's a good, strong investment for like a small package of your portfolio, right? So at $645 a share, I mean that's a one share basically of Tesla in your portfolio if you decided to do the 5,000 thing and break it down and displace something else for Tesla. If you wanted to follow the $625 rule for that. And of course, you don't have to do 8. You can break it up in even further if you wanted to and do like $500 per group of whatever stock it was. So SPYD here is what I was talking about. So it came onto the market, it looks like, what year is that? 2014, probably 2015 area. 2015 is what you can see, but 2014 is probably when it started. And you can see we're right at the top resistance for the long term. That's when it opened. But it's paid a really significant dividend for this whole term. It doesn't look like we're about to catch another downtrend here. This is on a max weekly chart, so this is each candle represents 1 week of trading. But you got that 36 mark as a nice support, and you're only $3 away. So in retrospect, that's really not that big of a deal. And even if you look at COVID, that big 2079 right there, that big drop that you see right here, that was COVID right there, and it suffered a little. So it went from 40 all the way to 20. So you lost 50%, but then look at that. You gained back the whole 50% and then some. So imagine if you would have held, continued getting your dividend, bought even more on this bottom, and then now you get the share price gain and more dividends on top of it. And that is why, this is almost a cup and handle going on right here. But that is why, you can clearly see the Bollinger Band showing your cup and handle too. That is why you have to pay attention to what it is you're doing when you're trading. Again, this is long term. So focus on what is important in your investment goals, right? And here you have NVIDIA, beautiful chart. This is max monthly as well. You're looking from 1998 all the way to 2021. NVIDIA earliest you see on this chart is 2007. We have a beautiful, beautiful push up there on the chart. But we may catch a little downtrend here. But then again, I think a lot of this is fear of the market. NVIDIA just did a split actually last week. On their stock, it was 4 for 1. So for every 1 share, you got 3 more. So totaling 4 shares and displaced of 1. So that was pretty awesome. Moving forward. As you can see, these are all examples of great long-term stocks based on their growth, ability, and dividends. Look at the things that matter. Again, the strength of the sector that they're in long-term. Examples are artificial intelligence, AI, EV, electric vehicles, biotech stocks, technology stocks, oil stocks, financial stocks, etc. The dividend consistency. So if you have stocks that are dropping, okay, we'll do a 10-cent dividend now, and then next quarter we'll do a 15-cent, and then next quarter we'll do a 7-cent. Those kind of things you might want to avoid. It doesn't happen very often. One-time special dividends, I rarely ever see those things come out with a profit on the end. People buy stocks, they choose to do a split, and then they're like, oh, we'll pay a special dividend, and you get all this cash in place of your shares, or whatever, some weird scenario like that when you get cash over top of your shares, or they're buying them back and you get cash for those, etc. It's weird. Reverse splits, something you never want to be a part of. Every reverse split I've ever seen, it has lost money. Every one I've been a part of has lost money. That's my own experience. So anybody that has been exposed to a reverse split that made money, then they're probably in the small probability of people that made money. Growth potential on that particular stock or ETF is very important as well. So again, SPYD, we see the price going up in the future. Neo, I see the price going up in the future. MJ, I clearly see the price going up in the future because marijuana has so much profit potential for these companies. It's unreal. Just because I believe the wide, massive use that people have on it. And the earnings per share, the revenue, the durability, and all market conditions. Again, like COVID we had, right? I feel like all the stocks that I picked had really strong incidents of during COVID. So even SPYD, but then again, SPY went from 339 all the way to 218. So that's a huge, basically 50% loss on an ETF. Okay, and now that same ETF is at 440 basically, and this is just 1.5 years later. So that's, you have to look at these things with a grain of salt sometimes because it can change so rapidly. Now, yes, some of you are probably saying, oh, well, that's because the government's pumping it or the Fed's pumping it and they're just loading cash into the markets. And this is true. Um, Banks dealing with a repo and reverse repo markets for liquidity and all that kind of stuff is, they need collateral or they need cash. And then we got a coin shortage and then crypto's taking over, et cetera. Like this whole thing, nobody really knows what's going to happen. The government can make their own cryptocurrency. They could turn around and outlaw all the other cryptocurrencies and just squash it all just like that. We practically look at it. How many people actually still have cash now? How many people have coins? How many, you know what I mean? The only coins that are worth money are the ones that are gold and silver, basically. Um, and it's like if you buy real gold and silver, maybe you're getting your earnings there, but nothing wrong with that. I think that's a great idea as well, at least to have some form of diversification in your savings or portfolio overall. Um, but these are definitely, in my opinion, great long-term investments overall. So utilize Google, obviously, to search details on these or other stock investments. Um, Use Google carefully, though, because the first few pages are generally ad-driven, and it's always like what gets the most clickbait, right? Because anytime you type something in Google, the first few things that pop up is always ad-driven. It literally says this is sponsored. So once you get to like page 10 or 15 on Google, chances are you're going to find good information, okay? Use quality news sources to study your stocks and ETFs. The reported forums, the 10Ks, 6Ks, etc. Like, reporting firms like Reuters, Wall Street Journal, things like that. Try to avoid the garbage clickbait like the Motley Fool, Seeking Alpha, and many others just like them. I used to like Seeking Alpha, but then I realized that they were playing coattail with the whole AMC situation. Basically telling people to sell like when AMC jumped up from like 12 to 30, and then they're like, everybody, you better sell, you're going to lose all your money. And then literally the next day that was at 60 something dollars a share. So for anybody who followed them and swallowed that pill, missed a whole $30 a share, so 100% gain from the day before. So that kind of stuff is just stupid, and I'm not saying that they were wrong or right in that scenario, but in my opinion, they're following the same suit as Motley Fool, talking a bunch of crap. Same thing with Kramer. He says all his stupid opinions, of course, about everything, but he's making tons of money, so who cares? Um, he's doesn't matter how much we like or dislike him, he's making tons of money, I'm sure. So keep those things in mind, right? Thank you for watching and participating in this free video. I will post this on YouTube once it's done downloading. Join Armor Bull Trading on Instagram, Discord, and Facebook. Armor Bull Trading is obviously the name, at Armor Bull Trading. The Discord is Armor Bull Trading. And on Facebook, I have Armor Bull Trading, and of course my own personal profile that links directly to this one. So with that being said, all you got to do if you want to be successful and you want more money is to think about, oh man, that sucks. It's supposed to be a picture of money. Anywho, but real quick, we'll go ahead. We'll give it 5 stars, but no, I'm not doing that right now. Let's pop on TOS real quick. Dun, dun, dun. So here we have Apple, right? And again, these are on my special charts that I have, on my scripts that I have built in. The best thing to do is look at long-term charts. So this is a weekly 3-year. This is a great chart you can look at. Clearly have this huge long trend, right? Like literally, it is a long uptrend, and that's all you see. Okay. Now, so let's go to so let's pick one of these other ones, SPYD. So you can clearly see this COVID happen right here, right? Look at this. You went from 39 roughly down to 20. But if you would have just added, say 10 grand roughly at this mark, you doubled that 10 grand already just since last year to now. You literally made 100% return plus all the dividends you get paid in between. Okay, those things you have to keep in mind, because look, that's 5% on your growing $20,000 at that point. So let's go Neo, and here's why I like Neo so much. So $50 target, we had over here, and we hit it dead on. Let me go and get that out of the way. And then we actually retraced back up to the 55 range and had another downtrend, but we are supporting nicely. And the red line is what it generally is in most places, is a 50 EMA. Let's click on this daily chart and let's see what we got here. Yeah, so you got a gap here, you got a gap back here, and this is all long term. So if you aren't careful, I'm just going to take that out, get that out of there. If we break through this line again back at 34, 32 range, that's when you're looking at possible trouble back to the downside, because we do have this gap at 22. So in my projection, right, my CCI is telling me the same thing, but it is getting down here to this way oversold area. My CCI is telling me that I should be on the lookout. Okay, so see how this little yellow band, this is my Bollinger Band, see how it's tilting down? When this one's following, they're no longer contracting, and there's a possible drip that we'll have, and that's a pretty fat bearish engulfing candle. So what we have to do is prepare for that a little bit. So we have a big downtrend, so I'm actually probably going to open up puts on Neo tomorrow, and we'll see where it goes. This is Thinkorswim TOS if you didn't know, but you can see that we have a pretty good oversold area here. And if you look at my Bollinger Band, you can see where it actually hit and then rejected and pushed back in. Now, there's one or two things going to happen. This could be actually a bear flag, and that could actually drip. It could reject this EMA here at around $39 or $40. Looks like about $40 will be the rejection, and then it's going to push back down more. And then the second time it retests this EMA, Bollinger Band, if it stays on it, it's going to keep pushing down. If it does not and it pushes back up, we'll be good to go. Look at an even longer term chart. Yeah, that's a pretty hefty, but a lot of times, as you see, every time it gets past that 50 EMA, it always pushes back up or tries to. So we're going to watch this 34 range. Matter of fact, I'm going to go ahead and put that in the chat, and because I got a perfect downtrend signal here, so I'm going to go ahead and short that guy tomorrow. Probably close some of my SPY shorts. Apple looks like it's going to turn out good. Excellent find. So you're getting free information here. And again, the disclaimer in the beginning of the video was relevant to this entire video. Let's look at Tesla. They had earnings, and now they're down to 639. But you see, the crazy thing about this market is they actually beat earnings by 100%, more than 100%. $1.45 was the actual, the 52 cent was the estimated. So it's just ridiculous that earnings was so great, but then you have this just ridiculous drop. Okay, there we go. Yeah, so you got your earnings, and then it just dripped all day. All right, and then all day, huge bullish engulfing candle, and then now you're dripping again. So this could be a bull flag forming. Nice double reversal here at the bottom, so double bottom technically. Same support as we had here back in, let's see, this is 150. Yeah, so you had another double support over here at the bottom, and now you're pushing up again. Now my CCI is telling me this could be the reversal, but then again, we could trickle back down. But it is in that super low range. If you look at the basis here, we're at pretty hard mark down below there, and same thing there. So you get that divergence, right? And you could be expecting a push up. Now my spreads that I have on this are expecting $700 a share or $580. So we're slap in the middle right now. So my spreads are gonna eat dirt for a minute, but come Friday, we'll see what happens. Let's do one more. I got asked about AMD earlier. AMD actually looks like it's going to go ahead and push up a little bit. I feel like it's a pretty strong burst there, so we could have a double confirmation going. I didn't quite get the third one, but that long-term trend definitely shifted back up, but it's failing right now. The issue is if the market does correct a crash, you're going to have that rejection. But it's funny because AMD actually does fairly well when the rest of the market seems to be suffering. AMD will drip down a little bit, but people just buy it up and buy it up and buy it up. So we look at a long term. Yeah, so 99 is as high as it looks like it's ever been. Let's go a little further. Yeah, so this was the previous all-time high. 50s back here, I think, somewhere. And then you had another high and then drip back down. I actually traded it here. I actually bought down here in the 12 range and then sold it at like 38. So the chart looks good. There's a lot of strength here, but it's coming back down to test where it broke out and made from resistance to support and then pushed up and continued support. Okay. But if it goes ahead and comes back down here, we're going to have an issue. So I think that $40 would be worst case scenario for AMD in a market crash scenario. But we have another W forming here. You can see it here. So technically that double bottom could force another push up. Let's look at the daily. Yeah, so you got the confirmation, but now you got a rejection. So we got to watch that as well. So this candle, you get another confirmation breakout. We get over, what's that, 94. If we get back to 95, I can see us pushing over and breaking up $100. All right. I think that's going to go ahead and conclude this video, everyone. Thank you so much for watching. We'll get this on YouTube as soon as I can. Thank you so much for joining. Have a good night.